Fintech lending was supposed to be the bridge that would enable entrepreneurs, small businesses, and even individuals across India to get access to much needed credit to build businesses. For millions of these companies and even individuals who are seeking a personal loan and would otherwise not qualify for them, usually because they were unsecured, these new age financial institutions were the great hope and sources of credit. Then in October last year, the RBI, like it usually seems to do these days, suddenly swept in and took action. It halted the loan disbursement activities of 4 NBFCs: Asirvad Micro Finance Limited, Arohan Financial Services Limited, DMI Finance Private Limited, and Navi Finserv Limited. In fact, between the time we recorded this episode to when we released it, the RBI had lifted restrictions from one of these companies, Navi Finserv. But why did the RBI do this? Well, there are some hints. Here are 2 quotes from the RBI about why they did this. Quote, "Deviations were observed in respect to income recognition and asset classification norms, resulting in evergreening of loans, conduct of gold loan portfolio, mandated disclosure requirements on interest rates and fees, outsourcing of core financial services." End quote. And here's the more interesting quote. Quote, "Unfair and usurious practices continue to be seen during the course of on-site examinations as well as from data collected and analyzed off-site." That's what the RBI said. But what did it not say? One of our guests, Atish Tanka, is the founder and CEO of AlsoVoice Content Solutions LLP and the former head of City Merchant Services. Regular readers of The Ken might be familiar with Atish. He's written about banking, digital payments, and merchant services as a contributor for The Ken. In fact, just last month, he had written a piece for The Ken asking why RBI is keeping certain companies locked out of the loan market. We've linked the story in the show notes and I really recommend reading it. The other guest who's joining me and my wonderful co-host Rohan for this discussion is Mithun Sundar. Mithun is a leader, growth advisor, and the ex-chief partner officer for Microsoft India. More relevant to this discussion, Mithun used to be the CEO of Lending Cart, one of India's largest lending platforms. In today's discussion, Mithun came in with an operator's perspective about the incentives, ideas, and the realities that lie before banks, fintechs, NBFCs, and the RBI. Throughout our conversation, both Mithun and Atish took the time to get into the details of how digital lending works, why private banks are hesitant to step into the ring and play the game themselves, what's up with sky-high interest rates charged on these loans, and of course, why credit is so important for India to grow and where we are falling short. Let's get started.
Usury. This is a very interesting word, and I actually sat up when the RBI brought it to my attention. That's right, the Reserve Bank of India. What actually happened is on 17th October, slightly over a month from when we are recording, India's Reserve Bank barred 4 key non-bank players, and one of them is really, well known, Navi Finserv, which is the fintech launched by Sachin Bansal, formerly of Flipkart, who went all in after Flipkart. And then DMI Finance, Asirvad Micro Finance, and Arohan Financial Services. The RBI barred these 4 players from dispersing new loans. And it gave reasons. Some of the reasons were, for example, quote unquote, there were failures of material, or there were material supervisory concerns there was also another one saying they were offering incentives to non-bank salespeople that were purely target driven. I mean, a lot of this stuff was like, but when I sat up was when I read that these institutions were barred because they were charging usurious interest rates, unreasonably high processing fees, and frivolous penalties. Now, the moment I saw usurious interest rates, I was like, wait, what? Because my understanding was the only context in which we ever saw the word usurious used in India was the bad old traditional money lenders. You know, the people to whom India's poor go when they have no option, the traditional money lender. And the traditional money lender has always been the big bad wolf who charges bad, usurious interest rates. And therefore, all of the innovation and work that we've done in the financial services sector and in fintech lending over the last 5-10 years, even more, has been to reduce the power of the usurious money lender. And here we had the RBI banning 4 very modern regulated entities from giving out loans because they were charging usurious interest rates. So I sat up because for me it was like, wait, how is this possible? And then I decided to kind of go back and read more about what is usurious. And it turns out there is really no definition of what is usurious. In fact, this is a great time for me to ask you, Atish, what is usurious? Because you, just before we were starting to record, you had given me a very interesting historical context of what is usury and what is usurious.
Right. So thanks for that, and thanks for having me on the show.
Thank you. You're
Rohan
our
and Praveen.
first
And hi,
international
Nikhil.
guest because we're recording with you from Singapore.
Now, so usury actually just means the charging of interest. That's all it means. And when somebody says that you're charging a usurious rate, they actually are creating a connotation of that denotation, which means that the interest rate you are charging is too high. Now, this only makes sense if there's a certain definition. That means, have you decided that the maximum you can charge is 29%, the maximum you can charge is 36%, whatever. That number is entirely up to a country, a state, or a monetary authority. In our case, it's the RBI. However, when the RBI accused these 4 entities of charging usurious rates, the problem is that there's no definition for them. In fact, curiously, the only legislation that exists in India with regard to usury applies to money lenders. Money lenders in many states are told that they cannot charge more than 18%.
Wait, what?
And they nod
Sorry,
their
what
heads
percentage?
most sagaciously.
18%
That's
per?
right. 18, 1-8. Per annum. And so they nod their head sagaciously and they say, yes, sir, and then they go and charge 180% or maybe 18% a month, right? And unfortunately, because those entities are not regulated, and the RBI, for instance, does not have the wherewithal to actually go in and, stop them from doing this, right? And a lot of it is off the books, as you all know. There is no real usurious rate that has been published in India, neither for the scheduled and regulated banks nor for the NBFCs. And in fact, this is the crux of the problem, because the RBI has made an accusation, but it has not given them a ceiling rate. Number one. Number two, even if they were to provide a ceiling rate, the RBI actually has to look into what are the drivers that drives the effective interest
Adish, I want you
rate
to
for
hold on.
NBFCs. It has not
We're
done
going
that
deep
either. Yeah.
into the weeds right now. Let's
Okay.
hold that
Sure,
back,
sure.
right? I want to kind of
Sure.
with the definition of usury. I get your point that usury traditionally, or
Right.
in its origin, meant just charging interest, but over time it essentially meant charging an exorbitant rate of interest. Now the question is, what is an exorbitant rate of interest and other limits? And I was reading up, and various countries around the world do set limits on what is a usurious rate of interest. Many states in the US do, many countries in Europe do. In fact, like you said, there are states in India as well that do set limits on usurious interest rates. Mithun, you're the former CEO of Lending Card. I know it's been a while since you left Lending Card, so I'm not holding you to any operational decisions that they're taking right now. But were you aware, what's your understanding of usury and usurious interest rates in the context of having been the CEO of a lending company?
First of all, again, thank you, Rohan, and thank you, PGK, for having me on, and a pleasure to be speaking with Atish as well. I would first agree with a lot of what Atish said, right? Which is about usury or a usurious rate is a reasonably arbitrarily fixed number, and there is no concrete guideline for anyone operating in the space on this is what you're not allowed to charge. To be honest, when as an NBFC, I mean, even the NBFC that I ran, as an NBFC that has come in, what you're asked to do is to be able to do two things. One, find the right target market, run the right control so your risk is measurable, and then lend in a manner where your business is sustainable across all of your products. Now, if your business has to be sustainable, you need to be able to make whatever that right profit margin is over and above whatever your costs are. Assuming that every company that is, and even the 4 companies that have been banned recently, assuming that they're doing a reasonable job of trying to get their costs under control, whether it's their borrowing cost or their operating cost, and they're doing a reasonable job of figuring out what is their adjusted risk, they will need to charge what they need to do to be able to make the profit. And if what they're charging is very high, then their profits would skyrocket and you'll have 50 more competitors coming in the market. So it's self-correcting in its own way.
That's an important point, which I think bears mentioning, that if we operate in a well, competed market with clear rules, and we are, there seem to be dozens and dozens of lenders out there in the market today. So if any one entity is charging a significantly higher rate of interest, I mean, it stands to common sense that someone else should offer reasonable interest rates and customers should go to them. That it may or may not happen is something that I want to talk about.
Well, here's the reverse of the question you said, right? If I were to take the unbanked or the underbanked segments in India, lot of new startups, whether they are, NBFCs, microfinance institutions, trying to find the right balance of what to lend. However, if you go to the significantly banked population, the folks sitting in the room here, there is a much higher concentration of the number of the main banks who actually hold their sway over here. And so, to be honest, I actually feel it's under-competed and much more commoditized on the actually banked segment. And some of what you're seeing here is a little bit of which lobby is pushing for what. And we can get deeper into it at your player. But for me, as I see it today, the writing's on the wall. The RBI governor spoke, I think, about this thing about 3 months back, about banks in the country struggling because people are overall depositing much lesser. People are spending much more. Where they used to be able to deposit, now it's going into mutual funds, equity markets, debt. They're putting a bunch of... So your total amount of, what they call the ratio of money sitting with the banks on which they give that, 4, 5, 3% interest rate, based on which they can lend, is going down dramatically. So banks are at this point squeezed. And when they see that squeeze is happening, and there's another segment of the market that's actually getting penetrated with a different risk profile, which they are unable to serve because they
unwilling.
just don't have.
Unable or unwilling? We don't know.
I think actually
as
from
of
a
yet,
business
right?
model perspective, it would be unable because you've set up costs for a different segment. It's like, when Radio Shack went down and the iTunes started, right? I mean, Radio Shack could have reinvented, but they can't because they're running costs at a different level and with a different profit margin. So I actually believe unable. Which is why the banks today they do want to participate in the sector, but they participate by lending to an NBFC like a lending card or to a microfinance institution. And then they onward lend, assuming all the risk and the cost. So my sense is it's an incentive play of a concentrated set of players who are today challenged with their original business model, working with the right influence to be able to try and curtail what seems to be happening in a much more competed segment.
Got it. Praveen.
I understand what both of you are saying. You're basically making this argument from a business model standpoint, an incentive standpoint, etc., which I all agree with. I think my only interpretation of whatever has happened is that, and we spoke about this just before the recording, that the whole concept of credit and debt, we are describing it in economic terms. Like there is this very famous book called Debt, the First 5,000 Years by this person named David Graeber. And he writes that debt is actually not just economic, but it's also social. Right? So there is a certain amount of social debt, there's a certain amount of social obligations. And I think that especially with lending, especially historically in India, over years and decades and centuries, it has always been a tool for extracting some kind of labor, some kind of rent, some kind of, indentured labor, all of these things. And so the definition of usury is actually not necessarily couched in economic terms,
but it's probably couched in social terms. So what I'm really saying is that the RBI is just looking at this and saying, I agree with you that it's saying, this is too much. This cannot be done. This is not good for society. Let's not do this. You have to stop.
But PGK, I have a reaction to that, if you will, right? Sorry, one moment, Atish. I have a reaction to that. I think the social cost of debt is true in the old model of a moneylender who lives down your street. You took 100 rupees from him in the morning, you had to give him back 101 that
Even
night.
microfinance, to a certain extent.
It could be
right?
microfinance, so if it's community
Group-based
that
microfinance.
because your social shaming or the social debt that you owe when you do not pay back actually plays in the community which matters to you. Right now, in the lending we are talking about, all of this is unsecured lending. There is no secured lending in this. So, and it's with a remote entity which is going through, only a app or through something that you've gone on the. So, if the economic cost or the economic outcome is not sufficiently imposed on you, you will actually have no cost to that capital. You could walk away
By
with that
you
debt
meaning
anything.
the borrower.
The borrower could. So it's actually much more minimal and it's much more amorphous. So in my sense, unless you're comparing it to a moneylender's lending or to a real community microfinance where you've all pulled in money and you're taking it out for an emergency, these things have limited social, impact, especially if it is unsecured. If it is secured, then you can possess the person's home or whatever the asset may be. But in unsecured, it has very limited social impact.
What you just listened to was just a small part of the discussion that we had with Atish and Mithun. If you want to catch up on the full episode right now, you can do that by signing up for a premium subscription to the Ken, which in addition to 2x2 will also give you access to all of our long form stories, premium newsletters and visual stories. Or if you're just interested in getting access to 2x2, you can access it, including this one, by subscribing to it on Apple Podcasts. Finally, if you're still unsure whether you want to pay for a podcast, we do unlock episodes of 2x2 a few weeks after they're published, just for a limited time. So I'd suggest you subscribe to this channel if you really want to listen to the full episode when we may unlock it in a few weeks. Until then, just check out our older episodes of 2x2. You may find a few of the unlocked episodes if you just scroll down on this channel. This episode was produced and researched by Hari Krishna. Rajiv Sian, our resident sound engineer, did the mixing and mastering for this episode.